The stock market sell-off continued the entire last week, and just before the close on Friday, there was strong buying activity. Have we bottomed, and are we looking to look for upside momentum, or will there be further selling during the week? We will do a technical analysis in this video of the S&P 500, Dow Jones, and the Nasdaq, and we will also look at the market gauges like the VIX and the put-call ratio. My name is Ashad Ahmed. I am founder of DIYstockpicker.com. If you are new here, please hit the subscribe button and support the channel. This video is only for information purposes, and please do your due diligence before making any investment decisions. There was so much action going on in the stock market last week. The Fed had its meeting on Tuesday and the meeting minutes were being released. Investors were on the edge because of the coming up rate increases. Apple and Microsoft had their earnings call. Both the companies delivered blockbuster earnings and increase in revenue. Tesla also reported their earnings. They had a beautiful fourth quarter, delivering a record number of vehicles. Usually Elon Musk is not attending the earnings calls, but this time he decided to attend, and he really spooked the investors. There was no information about when the Cybertruck would come, but he started speaking about robos and other things. That led to a huge sell-off in the Tesla stock. But Apple and Microsoft stock basically held up the stock market indices. Tim Cook delivered a very great earnings call, and he assured the investors that there is no much issue with the semiconductor shortages. The Federal Reserve had its confirmed meeting on Tuesday and reiterated what they had been saying all along. There will be an end to the bond purchase program and at least 4 rate increases this year. As early as March, the bond purchases will end, and there will be an increase of at least 25 basis points, which is 0.25%. Fed Chairman Jeremy Powell said that the economy is in better shape. There is now a need to tighten the monetary policy. Now, not only is Fed looking to end its bond purchases, but they're also looking to trim their balance sheet, which means that the bonds which are maturing, they will let the course run off and make no additional purchases and trim their $9 trillion balance sheet. The reason for the Fed's tight monetary policy has everything to do with inflation. One of the Fed's main responsibility is to fight the inflation. Mr. Powell reiterated that his job is not to support the stock market, but to fight inflation. The consumer price index rose by 7% during December, the highest since 1982. This index that the Fed follows, which strips out food and energy costs, and that index rose by 4.8%. And this is supposed to increase further as the new numbers come in. The labor market is very tight. The unemployment is sitting at 3.9%, which is just a bit greater than what it was in February of 2021. Many workers are quitting their jobs, hoping that they'll find better paying jobs. There are roughly 10.5 million unfilled jobs according to the Bureau of Labor Statistics. Companies like McDonald's are offering incentives to get back workers. Literally, Fed has been caught sleeping at the steering wheel. All through last year, they have been repeating the same thing, that inflation is transitory and temporary. The inflation is mainly caused by supply chain issues. Agreed, that was the case, but that was not the only case. The wages are rising, and that could lead to more money in the pockets of workers. More money supply in turn will lead to increase in prices, which is in turn leading to a vicious cycle of inflation. So Mr. Powell has reiterated the fact that monetary policy will be tightened and there will be pain ahead, and maybe a recession ahead, and that will be bad for the workers. The Fed is actually behind the inflation curve. If you look at the yield on the benchmark 10-year Treasury note, it has fallen 2.6 basis points to 1.782%. The yield on the 30-year Treasury bond is little changed at 2.091%. Yields move inversely to the prices. The important thing to note is the gap between 2-year and the 10-year yield. If the gap falls and the near-term 2-year is greater than the 10-year yield, that is an inverted yield curve. This is a very reliable indicator, and each time the inverted yield curve occurred, recession happened within 6 to 8 months. Let's start by analyzing the stock market indices. The Nasdaq opened Monday at 13,480 and ended the week at 13,770. Though there was extreme volatility, the market has traded in a range so far. The next week will either be a breakout opportunity or further consolidation. The support levels are 13,300 and 13,000 levels. The 14,000 and 14,300 levels are the next resistance. On Friday, the market opened 100 points up and came to sell, breaking the support until 13,250. Then the buyers came up and took the market up. There was one big red candle in the afternoon, immediately followed by buying. The 13,800 and 14,000 are the next resistance level. If the market opens gap down on Monday, 13,400 is a key support. If the market opens at the same place, then watch for resistance and selling may come in the afternoon. If you look at the S&P 500, the SPX opened Monday at 4,350 and ended the week at 4,430. The 4,300 and 4,225 levels are acting as support. The 4450 and 4530 levels are the next resistance. The market on Friday almost opened at the same place and came down to find the support at 4300 and started going up after that. There was a retracement in the afternoon, but once a breakout happened for 4400, it got a nice momentum. If the market opens at the same place this coming Monday, then it may test the 4400, and if it finds good support, a good momentum may come to 4500. The Dow Jones Industrial ended positive for the week. The index opened at 34,070 and ended the week at 34,725 for an almost 2% gain. But underneath this was extreme volatility. Monday, the Dow made a 1,000-point move after selling off to end the day positive. The 33,600 and 33,200 levels are acting as support. The 34,800 and 35,000 levels are the next resistance. On Friday, the market opened gapped up and sold 1% in the first hour. Finding support at 33,800, it rebounded until the afternoon. One big retracement candle at 1 p.m. Eastern and then right at the previous day's resistance with 3 green candles. The Dow is now at a breakout point. If 34,800 breaks, then it can go up to 35,000 for another test of breakout. The market sentiment index shows fear at this point. There are 7 indicators that are used to come up at this. We will go through a couple of them. The CBOE volatility index VIX is at 2766. This is a neutral reading and indicates that the market risk appears low. The put call ratio shows the number of puts traded to the number of calls. If the number of calls are more, that shows bullish sentiment in the retail investors. And if the number of puts are more, that shows fear. During the last 5 trading days, volume in put options has lagged volume in call options by 85%. The investors are making bullish bets in their portfolios, meaning they're buying more calls. This is among the lowest level of put buying seen during the last 2 years. This shows greed on the part of investors. So if we look from an investor sentiment, that shows that they're hoping for a rebound of the market. If you look at the market the whole of last week, it has been in a consolidation phase. Usually when a sell-off happens in a market, the market takes a pause and there will be consolidation where new buyers will be entering and sellers will be closing their positions. Actually, when the market went up Friday, Jim Cramer made a very good point that usually on Fridays, the traders do their short covering, meaning they buy and cover their short positions. So the retracement we saw on Friday may be a temporary one, but actually the market is at a very interesting phase. As we have seen, consolidation happens, and once the key resistance levels are broken and the market takes an upside, then there will be buy momentum coming in the market. But the markets never go up in a straight line. As they go up, they'll be hitting multiple resistance level on the way, and each time we may see retracements back. If the markets are making higher lows and higher highs, meaning that the markets are slowly trending up and buyers are stepping in. But if the key resistance levels are broken next week, then we may see a further selling pressure coming on the markets and the indices may go 2 to 3% further lower. I hope you found value in this video. If you did, hit the subscribe button and kindly share this video with your family and friends, and I hope to see you in the next video. Thanks for watching.